Today, I'm diving into the world of finance to see what really happens to gold prices when a new Fed chair takes over. Let's see if I can predict the market's next move. A change in leadership at the Federal Reserve can have significant implications for the financial markets, and gold prices are often one of the first to react. The Fed chair plays a crucial role in shaping monetary policy, and their decisions can influence the value of the dollar, interest rates, and ultimately, the price of gold. Uncertainty and volatility are common in financial markets when there's a change in Fed leadership. This is because investors and analysts try to anticipate the new chair's policy stance and how it will impact the economy. It's a period of adjustment, and gold prices can be particularly sensitive to these changes. The new Fed chair's communication style, their experience, and even their background can all influence market expectations. Previous transitions in Fed leadership have shown us just how much of an impact a new chair can have on gold prices. For example, when Jerome Powell took over from Janet Yellen in 2018, gold prices initially fell as the market adjusted to the new policy stance. But as Powell's term progressed and the Fed began to cut interest rates, gold prices started to rise. Then there's the transition from Ben Bernanke to Janet Yellen in 2014, where gold prices were on a downward trend due to the Fed's tapering of its quantitative easing program. The economic indicators at the time, such as low unemployment and moderate inflation, also played a role in shaping gold prices. A particularly significant transition was when Paul Volcker took over as Fed chair in 1979. His appointment was seen as a major shift towards a more hawkish monetary policy stance, aimed at combating high inflation. The immediate impact on gold prices was substantial. As Volcker's policies led to higher interest rates and a stronger dollar, gold prices initially dropped. However, the correlation between Fed policies and gold valuation became clear. As the economy adjusted to the new policy environment, gold prices began to rise in the longer term. This example highlights just how critical the Fed chair's policies can be in influencing gold prices. The period under Volcker showed that while short-term fluctuations can occur, the long-term trend for gold can be upward when investors seek safe haven assets amid economic uncertainty. In summary, the relationship between a change in Fed leadership and gold price movements is complex and influenced by a variety of factors, including economic indicators and the new chair's policy stance. If you have any thoughts on how the upcoming change in Fed leadership might impact gold prices, I'd love to hear them in the comments below. Also, if you're looking for more insights on how to navigate these changes in your investment strategy, be sure to check out my next video where we'll dive deeper into some actionable tips.